It gives me great honor, and it's really a true privilege tonight to introduce the teachers of our class, Saul Friedman and his son Simeon. Saul and his firm, Saul M. Friedman and Company, are from the most sought-after accounting firms in the country, especially in the firm community. Saul has over 40 years of industry experience, serving over 4,000 businesses nationwide. It is really a true privilege to have Saul and Simeon here tonight. They're going to address the 9th section of the business plan, which is the section on financial projections. And so without further ado, I pass over to Saul Friedman.
Thank you very much. Good evening to everybody. It's indeed a pleasure, a zchus, to be chosen to lead this class. And let me first give you all the agenda of our class, and we'll work it off of there. Every business should have a financial plan. What is a financial plan? Why do you need a financial plan? And when do you need a financial plan? Hopefully, at the end of this class, these questions will be answered. What documents, what project requirements are needed in order to prepare the financial plan? We need a balance sheet, an income statement, a cash flow. There's various different categories of what go into a financial plan. The most important, obviously, the most important part of a financial plan is the cash flow. You can have the best business in the world, but you cannot operate if you don't have enough capital. Once you know how much capital you need, where you're going to get the capital from. Most startups are people that are just beginning. They don't have billion-dollar bank accounts. Their funds are limited. It's very difficult to raise money for a brand new business. So we have to know how much we need and where we're going to get it from. The question of where we're going to get it from, could we go to a bank? Could we go to a father-in-law if they happen to be with a lot of money and they're generous to you, which normally is not the case? Or you find an investor that wants to invest with you. Again, if it's a brand new business, you don't know that many people that are going to invest in a brand new business because the risks are high. And finally, we're going to have questions. You can send in your questions. We're going to try and answer it within the class, and if not, we can always answer it tomorrow or the next day if we have your email address. So let's start with what is a financial plan? What does that mean? In the previous classes, you've been told you have a product, you have a niche, you have a marketing plan. We're assuming you have all that already. A financial plan is once after you've chosen the product you want to sell or the service you want to give. Now we're ready to start our business, whether we're going to manufacture or we're going to import or we're going to distribute. You're all set in that. We're here to deal with the financial part of it, the money part of it. And the question that you have to answer is, how much of this product will I sell? How much money will I spend in order to be able to sell this product efficiently? And at the end of the day, how much money will I make? We're not in here for chesed. We're not a not-for-profit organization. We're here to make a profit and make a living off of it. So we have to know how much money we're going to make. Which all this leads to, how much dollars am I going to need to run this company? I remember going to school in the early 70s, in a financing class. The professor asked the following question: when do companies go bankrupt? When they sell too little of their product, or when they sell too much of their product? Everybody in the class answered, obviously, if you sell too little of the product, your sales are low, that's when you go bankrupt. He quoted a financial study that was done in those days, where about 50% of the bankruptcies in the United States at that time happened because we had too much business. Now, that sounds kind of strange. How could you go out of business by having too much business? Because if you get orders that you can't fulfill because you don't have the money, if you're buying inventory and supplies that you cannot pay for, even though you have the business, nobody trusts you. That makes you in a very weak cash flow position, and companies go bankrupt or out of business just as if they had very little sales. So money, capital, is a very, very important way of succeeding in business. In short, it's a system. The cash flow projections or the business plan projections, a system for tracking the way you're going to run your business. Tell your business story to your investor, to your bank, to your father-in-law, whoever you're going to get the money from, by spelling out to them exactly how you're going to finance your business. Why is a financial plan needed? You could have the greatest product. You invented something. It's great. Doesn't mean it's going to be profitable. That's not the answer. A great product doesn't make it profitable. Why? Because no matter how great the product is, you cannot run a business without money. If you start off small and you're very successful because you have a great product, great. But how are you going to finance the growth? You sell, you have to buy inventory, you have to buy supplies, you have to pay payroll. Until you collect the money, you can have 2-3 months going by. You can have $1 million in orders. If you can't finance the orders, you can't fulfill it, you can have the best product you want. You have to also be able to anticipate the seasonality and the cyclicality and the ramp up of your business. If you sell kosher products, for instance, some of our clients do that. Comes the Passover, the Pesach season, January, February, March, their inventory is growing to double and triple the amount that they usually have. They have to finance that. So in any business, a business plan is not complete unless you're able to quantify how much money you need. If you're able to quantify how much money you need, it would prove that the business plan makes sense. And if it makes sense, people will invest with you, a bank might finance you, a relative might help you, and you can go on to become successful. As I said before, there are various reasons when a financial plan is needed. When you start a business and you're looking for investors, when you have a great product and you're looking to expand could be meaning another set of products or another machine or bigger customers. When you buy a business and somebody has a track record and you want to buy the business, how do you know the business will make money for you? And as the most important thing, if you're looking for outside financing, either as a loan or as an investment, it is mandatory to have a business plan with financial projections. And chas v'shalom, if the business is not successful and is losing money and you want to turn the business around, you have to come up with a plan how you're going to turn the business around. So at this particular time, to continue with our agenda, I want to introduce to you my son, Yaakov Simeon, who's my partner in the firm. He's been with me for over 10 years, and we've worked together very well. And he's going to go through the step-by-step of how a business plan of projections are done. And after he's done, I'm going to be taking the opportunity to do something really out of the box. I prepared a business plan for one of my clients, an actual business plan, and I'm not expecting anybody to be able to do what was done with this very extensive business plan, but it'll give you a taste to see in actuality, in a practical level, how a business plan can really help a business grow. And at this particular point of time, I'd like to ask Dr. Shimon to continue with the class.
Good evening. Now we're going to the section of where we can highlight and show how you even begin putting this business plan together. We understand that at this point in time, people have never done it before. It could be a complex matter, but it could also be a simple matter. And we have to figure out how to start it, and then build the model in a way where it's going to provide the information that you need, that you can present to either a bank or a investor. And as far as this project is concerned, we know that the requirements for this section is you would need to calculate your startup costs. In other words, what sort of funds do you need to start your business. In addition to that, this requires building a first-year model cash flow, which is on a monthly basis, following a year two cash flow projection on a quarterly basis. You would also have to include the assumptions that you used in building the model, and then supporting financials if applicable. There should have been a template that was supplied to everyone that they can use for this purpose, and I've reviewed it, and it is a very useful tool, and will sort of guide you how to start building the model. Now, what's interesting over here is the one item that is actually the most important item to build the model is the projection assumptions. Without assumptions, a model cannot be built. If one was given the task to build a building, and you go to an architect and you say, design a building, he won't know where to start, not because he doesn't know how to design a building. He has to know the footprint, he has to know how much space, he has to know how high can I build the building, how many floors can I build the building, what is the budget and what you want to spend for the building. These are assumptions that the architect would have to know prior to designing the building. The same idea would be with a financial projection. You have to have certain assumptions that you're taking, and they have to be realistic assumptions so that the model could be built based on those assumptions. In the template that you received, you would have a section where it calculates the startup costs. Startup costs can be the amount of money you need even before you do one sale. You may need money to invest in patenting your product, building up an inventory level prior to even starting to sell, starting in a manufacturing a plant, getting the machinery, hiring the people to put you in a position where you can actually go ahead and start business. And this is even before you made $1 in sales. So you have to calculate, what will I need funds-wise to start my business? This would be considered the startup cost. So if you want to calculate, if I get a certain amount of money for startup cost, and then I spend that money, you got to make sure that you're left with enough money that will feed into the operations of your business so that you can start operating as a business. So when you get money and you invest money and you start spending the money to build out the startup costs, where if you see on the spreadsheet, there's various different examples of how you get the money for startup, what you use the money for. At the end of the day, what are you left with so that you can run your business? Going to the next slide, and this is all on your template, in your Excel template. Whatever money you have left over, that is your working capital. Working capital is the funds, the cash that you have that you can run your business. The working capital is the starting point of the model. That is what you have to start with. And frankly, going back to the previous slide, if after your startup costs
you're left with a negative balance, then you have a big problem. You can't even start running your business. So when you make an initial investment, you have to make sure that even after you spend money on startup costs, you have something to begin conducting your business. The spreadsheet, not necessarily going to go through the detail at the moment. The main point of the spreadsheet is to show you how the beginning of this model is whatever cash you're starting off with. Just so that you see the sections of the spreadsheet, because you'll have to use it for when you build the models. You have the top section, which is the revenue section. Then you have the cost, which pertains to the cost of whatever product it is that you're selling. If you're in a service business, it may be labor costs so that you can conduct your service. If you notice, the revenue stream is broken out into 3 different categories, as well as the product cost is broken out into 3 different categories, because you may have different revenue streams of which you make different gross profits on or different margins on, and you want to isolate those revenue streams so that you can analyze and project what amount or what percentage of your revenue will be derived from whichever source it is. And below the cost of goods section, you have the operating costs, which you will have to make the assumptions as to what you think you're going to have to spend on the operating costs, and we'll be going through in more detail in how to go about doing it. Towards the bottom of the spreadsheet is something that is actually very, very important. After the line where it tells you if you're in a positive cash flow or a negative cash flow, there's a line that determines what your break-even point is, which is a very, very important part of your business model. In short, your break-even point tells you what is the minimum amount of sales based on your assumptions you will need to do to break even. If you don't hit those sales, you're in the red. If you go beyond those sales, you're making a profit. So it's very, very important to monitor your break-even point and ensure that you're generating enough sales to cover yourself. If not, you'll have to invest more money or get investors or lend money from the bank or borrow money from the bank just to make sure that you can cover yourself until you get into a positive cash flow. Second part of this projection that will be required is the 2-year projection, which will be broken out on a quarterly basis. And again, the model should be able to do that for you, providing that you supply it with certain assumptions. Now we'll see what goes into the plan, financial plan. The cash flow projections, basically you have to know the flow of funds, how much money is going to be going in and out of the business, how much money of additional will you need to carry the business. Once you know that, you may have to determine when you'll need financing, and you have to make sure that you have the funds to cover that. In other words, if you determine that you're going to be shorting cash based on your model, and again, being short in cash does not mean that it's not a profitable business, does not mean that it's not a good idea, but you still have to cover the gaps that you may find, at least in the startup couple of months, and where you'll have to cover the hole, so to speak. The rule of thumb is to start with enough working capital to carry at least 3 to 6 months of overhead. So at least you're covering your overhead. And whatever revenue and cash flow you're generating with the regular business just helps you move your model forward. As far as financing strategy, you have to figure out where are you going to get the money from. Knowing the flow is broken out into 3 categories, and that is knowing your inflows or projecting what your inflows of cash will be on a monthly basis, project what your outflows will be, and then see what your cash balance is going to be. And if you're in the negative, you'll know that you'll have to change your model in a way where you'll be in the positive, or figure out a way to capitalize the company so that you can continue functioning. Let's figure out how will we project the cash inflows on a month-by-month basis. Basically involves 3 steps. You have to develop on your product a sales price. You have to know whatever product it is that you're doing. It could be in the electronics business, in the food business. It could be a service that you provide if you're doing outsourced billing or whatever other business you want to get into. you have to know what you're going to charge your customers. Without knowing what you're going to charge for customers, you have no way of being able to project how much sales you're going to do. You have to know what you're going to be charging so that you can use that assumption in building your model. Assuming in a case where you're selling a product, you should project on a realistic basis how much of the product you're going to be selling or how many customers you're going to be servicing so that you can develop the projected sales amount that you're going to be done. Once you know the amount of units you're going to be selling and you know what your sales price is, obviously it's basic multiplication, you'll be able to figure out what your sales will be in that specific month. So, when you want to develop a price list for a product, and in this case we have an illustration of a Betty's Bakery, which has basically 3 products, where they determine that their price will be $2 for the brownie. They will provide a discount if you buy 12 or a dozen. The volume price, which is the discounted price, would be at $20. Or they have 2 other products, the wedding cake, which the price they'll sell for is $50. And the pecan pie, which they'll sell for $12. This again is giving you an idea as to how to break out your products, what you will price them out as far as what you're going to sell them for, and if you're going to have discounts in volume, you should take that into account in building your model. So you project the number of units you will sell or the number of customers you're going to service. If the products are very different, then you may want to project separate projections for each product that you're going to be selling. And that was going back to what we said originally. In our model that was given to you, there's 3 revenue streams, which you can in theory break it out so that you can tweak the assumptions based on whichever product or revenue stream you're building your model on. In addition to that, you have to realize that in the beginning, it'll take time until the customers respond to your marketing, and or you may have seasonality issues. You have to take that into consideration in how you project your month-by-month sales. Meaning if you know that there's certain busy times of the year, you can up your projection as far as how much you will sell, and vice versa if there are times when it's a little slower, depending on the type of business you have to determine in the 12-month period how the revenue will go up and down based on the circumstance. So in this specific case, we have the projected number of units sold per product from January through June of 16. We're projecting that we'll be selling, let's just look at January, 20 units of the brownie. We'll sell 5 volume of brownie, which is in short 5 dozen. We'll sell a wedding cake and a pecan pie. This is the projected units that we will be selling. Once we know that, we can then calculate what amount of sales we're going to be doing for the month. And obviously based on, if we go back to the previous slide, we have the prices set, so it's very easy to calculate what the amount of sales you're going to do for this specific product. Finally, assuming we're going to do the sales we're going to do, based on what we projected, we know what is the amount of sales or cash we're going to be getting from our customers. You put the cash amount for each product into each month based on the amount of sales you're going to be doing, so we know what the inflows are. You want to make sure that you have the total for all the products in each month. This will be the total inflow that you'll have on a monthly basis. That inflow is what you're going to have to be able to pay your expenses. So in this case, we take all the sales number based on this illustration. Here is the items that you're going to be selling. We know what the total sales are going to be based on the pricing and the amount of units that you're going to sell.
Question that just came in.
Yeah, so there was a question over here. How can you estimate how much you will sell before you start? Now that's a very, very good question. Nobody knows the answer, and if somebody would know the answer, there'd be lines around the block if somebody had that crystal ball. So nobody has the crystal ball. The idea is, obviously, if you believe you have a product that is marketable, you have to go with an assumption that makes sense. And if You can realistically say that you'll land one customer the first month, two customers, or you'll be able to sell X amount. You got to start somewhere where it makes sense. Nobody expects you to roll out a product and be able to sell as much as you want. You have to be conservative about it, providing that if somebody looks at your business plan, they say it is a realistic estimate, and then obviously you would rev it up. But there's no answer that there's no way that you can estimate how much you're going to sell, but you have to start somewhere with a realistic goal of what you anticipate you're going to sell. Now let's go to the operating cash outflows. Yeah, hold on one second. Yeah, there. So you wanted to say something.
Let me try to take a stab at this question. It's a very good question. How do you know how much you're going to sell? The answer to this question is research. Before anybody starts a business, you should go out into the marketplace, try to visit your competition, maybe not next door, go to another state or to another city, call and ask for pricing information, look at people's websites, look at people's brochures, look at their Facebook, look at their publications that they might have, and that'll give you a feel as to how people entertain or budget their dollars to buy your product. You can go on the assumption that if you go to a competitor and the competitor is doing $1 million a year, so obviously this product has demand. You can't start off by saying that you're going to have $1 million your first year, but you can go on the assumption maybe you'll do 10% of that, which is $100,000 a year, which is about $8,000 a month. You have to have a starting place, and where you get the starting place is you have to do a shtadlus. You just can't go to a rabbi for a bracha and he should tell you how much he should predict for you how much money, how many items you're going to sell. But once you know that the joke is, I once went to a rabbi and he said, I want a bracha for my business. He asked him, what business are you in? He says he has a chapel, a funeral home. So the Rebbe looks at him, you want me to give you a bracha for a funeral home? He says, no, I know you can't predict and you can't say people should die to come into my business. But the bracha you can give me is when, chas v'shalom, somebody dies, he should come to me. Now, how do you know that somebody's going to die? Because that's the normal way. There are statistics for that, how many people in the community need these services, and you're hoping you're going to get some sort of demand for your service or for your product. So the best startup that you can have is finding the sources where you can do research in order to determine at a minimum how you start in your own business. That's how I would answer the question. Back to you, my son.
Perfect. Okay. Continuing, we're getting to the next section where we have to project what our operating cash flows are going to be. There are three parts of operating cash flow. One is the cost of the product that you're selling. You have to know what the cost will be for the product, either if it's you're distributing product or you're manufacturing product, or if you're providing a service and you're going to have labor costs. You have to understand the costs that go into that product, and that would give you an idea as to what you're going to need to spend to either pay for the labor or pay for the product. Then you have to have an idea as to what the operating costs of your business would be, which is beyond the cost of the product. If you have salespeople, you have trucks, you have to pay rent, you have telephone, there's wages, administrative wages. These are operating costs which are usually repetitive on a month-by-month basis, but it is not tied to the actual selling and buying of the product. And the last necessary outflow that you may have is capital expenses, which is usually one-time expenses, such as if you have to buy a computer, you have to buy a piece of equipment, you have to buy a truck, you have to develop a website, software. These are one-time expenses, but you will need the cash up front, but you will only reap the benefits of those assets in the future. So that's the third type of expenditure that you may need, which is part of the operating cash flow. As far as figuring out the cost of goods sold, the cost of goods sold is basically the inventory that you're selling. It is as simple as figuring out, or as basic as figuring out how much you're going to sell. If you know how many units you're going to sell and you know what you're charging for the units, you can figure out what your sales price is. If you know what the product costs you and you know what amount you're expecting to sell, you will know how much product you will have to buy to sell. Obviously, if one wants to carry an inventory so that they can service their customers and they may be buying product beyond what they're going to sell in that specific month, that obviously is an investment. They're going to have the cash for that, and they're only going to sell it beyond that specific month. They have to take that into account as far as the outflows are concerned. How do you calculate the cost of goods sold? It's very easy. You basically take the same unit volume as your cash inflows, which we saw in the previous slides, and you multiply the cost per product to determine what the total cost of what you're selling comes to. You take the total cost of goods sold, you take it off the sales. So if you sell for $1,000 and the product costs you $800, your total net cash inflow after paying for the product would be the difference, or in this case, $1,000 less $800 is the $200. So in our scenario, we have the three products. We're assuming the cost will be $1 for the brownie, the wedding cake could be $25, the pecan pie is $6. We already know the volume of units you're anticipating that you're going to be selling based on the projection for sales. We take those number of units by month and we multiply them out by cost. That gives us the total cost per product. So now, with this basic illustration, we understand what the product will cost me in dollars. How about operating cash flow? How do you project that out? You have to create a list of the expected expenditures that you are going to need to run your business. You put the list together, and then you have to determine what will each line item cost. If you know that you're renting a location, it's costing you $2,000 in rent, you know that I have a fixed overhead of $2,000. If you're hiring a receptionist, you're paying a couple $100 a week, you know that that is a cost you will be paying regardless of if you sell or not. Utilities, professional fees, any expense that you will need to run your business, those are the fixed expenses, and you would quantify those expenses to come up with a dollar amount, which is your operating overhead. Projecting operating cash flows create categories for the expense of cost, which is what kind of things are needed to operate the business. Each one part of an operating expense category, you have to pay it regularly, and this is going to be operating overhead. Here are examples of expenses that you may have for overhead, and every business could be a little different, but in general, these are expenses that every business will need to pay, which is labor costs, sales, rent and utilities, telephone, office, postage and shipping, travel, insurance, professional, other. These expenses are usually consistent on a month-to-month basis. In our illustration, you have to make an assumption as to what the costs are. So for labor, let's say you're going to be paying an employee $10 an hour and they work 40 hours a week. You can quantify what that expected expense is. Sales and marketing, in this specific case, if you're spending a certain amount of money on advertising, you should quantify what amount of advertising you're going to do and at what cost it will be. Same for telephone, quantify it if it's $100 a month, office supplies, postage and shipping, travel, insurance, professional. These are all illustrations as to how you can quantify each overhead expenditure. Once we have the list of expenses and we know what the costs are, you can then total up what your overhead is. Now, there are certain expenses that are deemed fixed expenses, meaning no matter what your sales are, those expenses will be fixed. Rent does not change. If you do sales for $10,000 a month or $20,000 a month, you pay the same rent. But there are some expenses that you have to take into consideration that would be considered variable. For instance, let's say you pay commissions to salespeople, that's tied into your sales. So if you want to project what your sales are, you want to project what your commissions are. If you know that you're paying 5% commission, then you can simply calculate it based on your expected sales. So although it's a fixed expense, meaning it's something that's going to be recurring month to month, but at least it's a variable expense based on the volume that you're generating. So you can't just take the expense list and divide it up into 12 months. You have to figure out ways to concisely get to the expense amount, and if there are variables, take that into consideration. For instance, if part of your expenses are doing, you're a call center and you're projecting how many calls you're going to be making, when you're not servicing as many customers, your telephone expenses will be less than they would be when you do service customers. So in our illustration, if you calculate the labor hours, here on the right side, the quantity tells you what the, actually in this specific case, you can determine what the cost is. If you look at the cost, if labor is $10 an hour and there's 40 hours, you would want to quantify that. Rent, for instance, $500 per month for the office and storefront. Telephone and internet, it's $100 a month, which is on a monthly use. So this basically figures out what each expense is and what our expected costs are. In our specific illustration, we take these expenses and we populate it to come up to a total. We got labor. If it's 40 hours a week at $10, we know it's going to be $400 for the week. For the month of January, sales and marketing, we're projecting at the $25 going down the list. You get to the total of $1187. Now, if you see on the right side, this sort of gives you an idea as to which expenses are variable and which expenses are fixed based on the amount of this could be based on how your business generates revenue, or it could also be if you decide that for travel purposes, I'm going to be traveling a certain amount a month. It's not necessarily fixed because you can sort of tweak it. If I'm going to decide that I want to travel to 10 customers a month versus 5 customers a month, those expenses will go up and down based on how you're building your projection. What are capital expenses? We said that one more outflow example would be capital expenditures. That is if you buy fixed assets that your business is going to own for the long term. So even though you're going to own it for the long term, right now you have to pay for it up front. A lot of capital expenses are actually within the startup cost, but you may also need to buy more equipment to expand your business. You may, every couple of years, get additional equipment, and as such, you have to take that into consideration as well. Here are examples of capital expenditures. You have the equipment, you have office equipment, furniture, building, if your business needs it, if you have to improve a building, invest in construction, or if you get a vehicle. These are capital expenditures, which is really one-time expenses. You have to take that into account. In this illustration, Betty's Bakery, here we are again. We're projecting that we're going to be buying furniture for $300, equipment for the office $2,000, equipment for production would be $4,500, and a vehicle would be $7,500. We then multiply it exactly the same way to figure out what our total startup expenses would be on the capital expenditure side. And then beyond that, you may want to know what you anticipate in a year from now or 2 years from now, what it is that you may want to buy, so that when you roll your model further down the line, you may want to put in additional capital expenditures. So now we went through the three parts, which is the inflows projected based on the sales, the outflows, which are projected based on cost of your product, labor, and overhead and expenses. That would be your outflows. In this specific illustration, we're dealing with an inflow of $262, an outflow of $17.17, and then you have capital expenditures of $14,300, and you can see in the illustration back here the total for the initial capital expenditures, the $14,300. Right now we are in the red for $15,755, which is, in my first month of revenue, I will not generate enough cash flow to cover my overhead and my capital expenditures. And here is where you have to figure out how you can get money to get enough cash that you shouldn't be in the negative. This negative number is what your cash balance is and what your needs are. If it's positive, you're in a positive cash flow. If you're negative, you're in a negative cash flow. In which situation do you need cash? In a month where the business expects a negative cash balance or a negative cash flow, because you cannot count on the business to provide the operating cash. So you have to fill the gap. As we said, trap the gap. Here is where you're going to need money. As you see in this illustration, going through the projection that we created based on the assumptions we had before, you can see that every month has a different projected cash balance. So it's simple to see that which month would you need outside or extra cash. Obviously, it's going to be in the month of April and the month of May. In the month of June, you're finally in the positive cash balance. So basically, the idea of building this model is figuring out, based on the assumptions that you're making, what is the amount of cash that you're going to need so that you should not be in the red. The more realistic your model is, the easier it is to get people to help out either via investments, loans. A startup company usually you'll have a difficult time getting bank financing. If you are an existing business but you want to improve the business and you want to justify bank financing, a projection would help. If you're in business for a couple of years but you want to go into an expansion, and based on that expansion you want to build a model as how your business is going to look beyond the expansion, a projection is going to help. It always is important to be conservative, because if you're going to build a model that just does not make sense, it's too good to be true, an avid investor or a bank would see through it, and they're just going to say that your assumptions are just not realistic. Therefore, it's important to be as conservative as possible. And if you're able to put together a plan where month by month you meet that plan, or maybe you beat that plan, you'll get more confident investors in knowing that what you're trying to do makes sense, and there's a more likelihood that you'll be able to get the financing that you need. So as far as our business plan component, go back just to review quickly. You develop your marketing strategy, which is how you're intending to sell your product. You figure out how you're setting up your operations, make sure your finances are organized and in check, where the business projection will tell you that, and then make sure you do the market and competition analysis. At the end of the day, as you realize, the financial projection is a very important component of this cycle. The question over here is, what about pricing strategy? How do I know how to price an item correctly? Now that's a very, very good question. Obviously, if you want to sell a product for a price, you have to make sure that it meets the market, which is to say, if you do research on the product and you know what the price goes for, you have to be within that range. Unless you add a twist to it, which is maybe you would want to charge more for a product, but you add a twist to it where you add a certain service to it. For instance, I get you the product within 24 hours as opposed to waiting a week. You can always increase your prices based on what you're adding value to that product, but you have to do the research in what the product costs. As far as if you're developing a product, you have to really drill down and know what it costs to develop the product. Once the product is developed, you have to figure out what it costs to manufacture the product, which then gives you a cost of which you calculate what is the markup that you can put in place where the market will buy a product. If you outprice yourself, then you're going to put in all this investment and you'll have a difficulty selling it because you're overpricing yourself. So you have to do the research, either what competitors charge. If it's a new product, part of the pricing comes with understanding what investments go into developing the product, where eventually you're going to recoup this investment. At this point in time, if there's any other questions, we would take the questions. You can still send the questions in. I'm going to hand over the reins to my dad, as he's mentioned that he's going to show a real live business model which is more complex than the business model that you're going to be required to put together. The idea is to give you insight as how powerful this tool can be, where if you have assumptions and you tweak the assumptions, it can change the model completely, and it can give you reams of information where it's going to help you make decisions and how you should conduct your business.
Wow, what a presentation. You give me much nachas, Yaakov Shimon. You would make a good teacher. There's a joke, they say those who don't know accounting teach it, and those who know accounting practice it. I'm glad you're practicing it. I'd like to give you a treat. I consider this a treat because what I'm about to present to you is something which I and my team at our firm, especially my youngest son, Avrumi, helped me create on an Excel spreadsheet. And this is an actual business plan that we've given to an actual client. For confidentiality purposes, I took out the name of the client, and I did use the numbers that I presented to him with all the hypotheticals. And the reason I call this a treat is I'm going to show you a spreadsheet which you can follow. Trust me that the calculations are correct, and what you can do to manipulate a business to either turn it around or to attract a bank or to attract investors. And let's use the illustration. I call this, it's a sample client of SNF Co. That's the name of our firm. The first sheet is what I call the assumptions only. The way I like to do projections or anything else, I have page one with all my assumptions, and after I put in my assumptions, all the other reports flow from it, and I have to make sure they're in balance. So the most important one is the one right here where it says master control 0. As long as this is 0, that means that my cash balances and everything is correct. Here's a customer, a client that's been in business for 3 years, and he's come to me that he needs more money, and he has to go to a bank, and he has to present to them what he's going to do in order to generate enough profits to be able to pay the bank back. So, on the left-hand corner, and this I'm only saying this one time, and you can take it for granted that it works. If you look, you will see items marked in orange. Everything that's in orange is an assumption that we have to fill out in order to get the correct projections. So, let me run through it and I'll show you what this is. Obviously, you start 12 months with the dates. January, February, fill that out. We're talking about the year of 2016. Although this was prepared in 2013, we're using a 2016 date. Then, the first item we have here that I'm pointing to is the sales that we're projecting we're going to have, which is $12 million in sales. We're making it a little more complicated. We're not saying we're going to do $1 million a month. So we sat down, we figured out, based on seasonality, as we discussed before, what percentage of sales will be done in each of the months. As you can see, we're starting out with 7%, 6%, and it goes up to 7%, 9% of the year, as long as the total equals 100%. And then purchases. As I said before, inventory for certain seasons, you need purchases, you need to buy more stuff. So again, it's not going to be bought on a straight line basis because that's not realistic. When you teach it, you do it the easy way, but in actuality, it's not really done on a straight line basis. It's done based on historical records. We're starting off with a beginning inventory, because this is how much inventory they had, $770,000. And we're putting in, based on knowledge that we have, how much purchases we need, how much labor we're going to have to do, how much supplies and parts, how much freight in, and other direct costs. That tells you what my costs are. All this is, again, based on sales. In other words, if you take, for instance, direct labor, you will see as the sales go up, the direct labor cost goes up. These are all variable costs that go into the cost of goods sold section. Inventory levels are determined by a formula which is based on what my gross profit is. In other words, if I know that my gross profit is 25%, I know that my cost of goods sold has to be 75%. If I have too much purchases, obviously some of it is left in inventory. This spreadsheet takes care of all that. My selling expenses, for instance, if you look at it, sales salaries is based on a formula based on sales, 2.7% of sales, and commissions is 2.1% of sales. The other expenses which I filled in, which doesn't happen by itself, is straight line. Basically, it says how much my advertising will be, and again, I put this in, and the computer calculates the bottom line, how much it's going to be. The same thing is with my general and administrative expenses, as Yankee Shimon discussed before, salaries, maintenance and repairs, data processing, postage, printing, payroll taxes, everything else based on historical. We know how much it costs a month. These are all assumptions, first of all. My gross profit percentage, which I'm using for this particular percentage, again, is something that I fill in. It's an assumption. Right now, it's 25%. My next assumption that I'm making for the purposes of this is the officers are not going to put in any money, so there won't be any distributions to shareholders, and there won't be any investment by the shareholders. Zero. We'll leave this available collateral for a little later because that's really complicated. Then I'm giving a statistic of how I collect my receivables. Within 30 days, I'm going to collect 35%. So if I sell, let's say, $100,000 a month, I know that 35%, $35,000 I'm going to collect within 30 days. The next 60 days, I'm going to collect another 35,000. In 90 days, I'm going to collect 5,000. After 90 days, I'm going to collect 23. Obviously, people are slow in paying. And uncollected, meaning receivables which I won't collect, will be 2%. And the same is with payables. I put in that 30% we're going to pay within 30 days, 40% we'll pay within 60 days, and within 90 days I'll pay 30%, which totals 100%. Obviously, we're not going to say that 2% we're not going to pay our vendors, because that doesn't exist. We're honest people. Then we have covenants that normally a bank gives you, which we shall skip. Taking all these assumptions, here is your treat. Taking all these assumptions, I have now like this. First of all, my master control up here says 0. Right now I'm in balance. And what means I'm in balance is here is where it is. Now let's look at the next sheet.
Just to interject, people realize that the only information you really entered into this sheet is what's highlighted in light orange.
Correct.
Light pink.
Everything else happens by
is by
itself.
itself.
Absolutely.
Those are the assumptions that you took, which builds the assumption sheet.
Yeah, but I have to know that when I change an assumption, I'm still in balance, meaning everything is accounted for. Okay. Let's look at the results of what this produces. If we went through before, part of our agenda was the project requirements. What kind of reports am I going to have to generate? So here we have. The first thing we have here is a projected income statement. What I put on my assumptions will give you an income statement for each month. It'll tell you what my sales are, what my cost of goods sold are, what my expenses are. You remember we said it's 25% gross profit? It's 25% gross profit. After the end of the day, we lost $52,000 we lost for the month. That's a great month that we had, etc., etc. And the sales, as I said before, fluctuate. This gives you an income statement that tells you all your expenses, all lined up. You have everything that works, how much the salaries are, overhead, postage, maintenance and repairs, everything else you have right there. Once we're done with that, we now could prepare cash flows. In other words, how is my bank account going to look? Now, watch what happens. In January of 2016, I start off with a beginning balance, because remember it's an existing business, of $67,000. We collect accounts receivable. How do we know what we collect? Again, we have the formula. If you go down, this tells you exactly the formula of how I got to this number based on the assumptions we had before. We're going to collect a total, according to this, of $853,000. Then we're going to pay our accounts payable, we're going to pay our interest, we're going to pay our direct costs. After paying all the expenses that we have $942,000 of deductions, meaning of expenses and outside other items, and that gives you a cash balance of negative $21,526. So using this, we now see that if we have these projections, and let's go back to the assumptions. I did the thing marked in green. This tells you that after going through an entire year of calculations, it's a wonderful business. I made $87,000 in profit, but I need $1,078,000 in cash. Obviously, the way we're doing things, we cannot exist in business because we don't have the $1 million to put in. We need $1 million. If you look at the backup files, you need $1 million. So you come to your accountant and you fadre him a cup and say, what do you want me to do? How can I succeed in business? How can I build my business? So obviously, I as an accountant hear a lot of sob stories, and it would be very nice if I had an account with $500 million and I said, you're short $1 million, here's a check, and everything is fine and dandy. That is not the real world. That's not how it works. So we start discussing what can we do to help this business. The first thing we can do is watch what happens if I take the $12 million in sales that I projected, because I did that last year, and somehow I could improve it to $18 million. It could be 1,800, as you were discussing the little bakery, but we don't deal with little bakeries, okay? Now, watch this. If I'm able to do $18 million, or everything else considered, I only need $532,000 in cash. I now brought down my cash requirements. Why is that? Because instead of making $86,000 as we had before, we're making $1.3 million in profit, all things remaining the same. But that is really not realistic. I'm not going to go from 12 million to 18 million That's not how you really do a business, because anybody can do that. There's other ways of improving the business. Let me show you something else. This is a difficult thing to do, but you can concentrate. Watch what happens if I take my 25% margin that I was working with and I improve it to 33%. Now, I have to also say, let's go back. I have to say that many times, I encounter situations when I sit down with somebody as doing projections, and I literally ask him, and it might seem like a stupid question, I literally ask him, how do you calculate margins? For those of you who have learned the Gemara, it's milabar, milagav. I wonder if you heard that. And I say to him, if you have an item that costs you $10 and you want to make 25% margin, what would you charge for the product? Most people would say they would charge $12.50. Why? 25% of $10 is $2.50. That's $12.50. That's wrong. That's not how margins are calculated in the business world. Margins are calculated based on sales. In other words, $10 would be 75% of the selling price, which in this particular case would be $133. 25% of that is $33. That's how you reach the $10 mark. But let's see what happens. If I improve the margin to 33%, I still need $1 million in cash, but look at my profit. My profit went from $86,000 to $1,047,000. It doesn't help me with my cash because I still have to cover receivables, I still have to cover payables. But being that I know that in order to raise my profits, I have to raise my margins, what is my solution for the cash? One solution is cutting expenses. And that's one of the things I look at. Look at all those expenses that we have. We have here officers' salaries at $120,000. Who says you have to make $10,000 a month when you're living off of borrowed money? If you put in that officers' salaries instead of $100 will be $100 a week, for argument's sake, minimal. So if you change the $120,000 to $100 a week, okay, which is $5,000, watch, the cash now went down. That helps your cash. I just use that because I want to pick on the owners of the company, because you really can't cut telephone expense. Try going to AT&T or Verizon, try to get that cut. So cutting starts with you. So that's one of the things. Another thing, for instance, employee benefits. I have it at $110,000. Who says that the minute the people join, you have to give them health insurance? You can lower that. If you lower that, you cut that down. Look up, and you'll see we're now down to $900,000 of cash. These are chipping away at the expenses, but that doesn't give it to you all. You can also, one of the answers you can give is, let's see how I collect my receivables. Right now, we have receivables that in the first 30 days, I collect 35% of my receivables, and after 90 days, I collect 23.5%. That means that a lot of money is out there. Supposing I change it, supposing I say that after 91 days I collect 5%, put in 5%, and now the difference that you have is add to the within 30 days. How much is the difference, Simeon?
Plus 18, plus 17.
Which is 30, is 17, is 52%. Now let's look if we're still in balance. Yes, we're still in balance. Watch this. Look at how my cash went down. I only need $282,000 of cash because I'm able to collect receivables better. Imagine sitting down with an owner and showing him this black and white. Look what you can do to improve your business. Okay? There's one other thing that you can even reduce it further. Try to go to your supplier and say, I want to turn my business around. I don't want to pay within 30 days. I don't want to pay 30%. I only want to pay 10% within 30 days. Change it. I want to pay 40% within 60 days, and I want to pay 50% within 90 days. You're giving me an extra 30 or 60 days in turns. Now let's go back up. Look how much cash. I have more cash than I need. You see all these components, or everything that we need. However, all these things are just tools that you can look at and see, if I do this, anybody you go to is going to say, cut expenses. Big deal. If I knew how to cut expenses, anybody would do that. But if you show them black and white what actually happens when you cut expenses, what actually happens when you negotiate with a vendor, what actually happens if you go to your customers and say, help me out, pay a little sooner, you can solve your problems. However, let's go back and say all these things don't happen, okay? And let's close this out, not save it, and start again, right? Okay, we'll go back to our...
2 minutes. 2 minutes. 2 minutes.
Okay, now go back. Could you... Okay. If we go back now to our assumptions, if you cannot solve, remember again, we have an $87,000 profit, we have $1 million that we need. One of the ways to do it, and this is what I told my client, he's done all his cuts, he's done everything he can with the vendors, he has to take out $10,000 a month because if not, he won't have shalom bayis, etc., etc. The only other thing that's left is you got to go to outside investors. And here's what happens. If I put in investments of, where is it? Investors by shareholders. Right now I have $10. Let's put in $250,000 he starts with. And in this month he puts in another $250,000. Now let's see, he put in $500,000. As we said before, we're still short $579,000. So now I got to go to a bank. I tell the bank, look, I'm making a profit, but I need another $500,000. So we go to the bank, and the bank doesn't give it to you piecemeal. The bank says, after 6 months, if you can show that you can do the projections that you said you're going to do, in July, we're going to lend you $500,000. We lend up $500,000, and now, if you look at it, we're down to $79,000 negative. We funded all our cash flow deficits. We funded by putting in money, our own money, and putting in the money from a bank. Now, if on top of it, let's go on a minimal basis, if on top of it you increase your gross profit from 25, not to 33%, but you do it to 29%, halfway. If you're able to do that, I'm using that as an example. Look at this. I'm almost break even in cash, and I made $567,000. Let me tell you all, this is not something that a layman can do. This is not something even a sophisticated accountant can do. This requires a lot of work. But I want to say this to you. It's not expected of you to prepare this, but what's expected to you is to know that all these things are possible to be done. So when you go to your accountant or your financial advisor, you say, I want to give you all my assumptions, and here is, tell me how I can improve things. So I hope that you got out of this, first of all, the flavor of what a business plan and projections are. Also a flavor of how to participate in this contest, which unfortunately I was chosen as one of the judges, and I won't judge you by my presentation I just made. I will judge you just by the thought that went into the process of being able to develop your plan. But if you have a plan, if you know where you're going, if you know where you came from, in other words, you have your business experience, then obviously you will not be caught by any surprises, and you will be able to continue your business with much hatzlacha. Thank you so much for giving us the opportunity to share this with you. And I just want to add that at the end of, or you can find out, I'll open a special email address that you can contact me directly with your questions, and I will try to respond to you as soon as time is available to me. And I wish you all hatzlacha in all your business endeavors, and maybe one day you guys are going to become billionaires, and you'll be able to fund a lot of businesses, not based on projections, but based on brachas and yeshuas for all. Thank you all for listening.
It was a special treat, Saul. Yasher Koach, thank you very much. Everybody, as you heard, Saul, we're going to send out to you a special email address if you have particular questions. Saul and Simeon will be able to help you with those, Imrit Hashem. Next Monday night is the next class. Monday night, we're going to have the marketing plan class with Yossi Applebaum, Joe Applebaum of Ajax Union. We're looking forward. Everybody get to work on those financial projections. We're looking forward to the next class. Have a wonderful Shabbos. All the best.